Hello, it's Paul Green again with another one of our regular Focus On panels where I invite a panel of experts that I think know their stuff that can actually talk about a particular business topic. And as you can see from the ticker going along the bottom, we're talking about tax today. So I believe the only two certain things in life are death and taxes. So taxes today, we might do death at a future point, who knows. So before we crack on, if we can just go around the room and introduce you to my guest today. So Wendy, do you want to let people know who you are and what you do?
Good morning. My name is Wendy from Bean Counters. We offer an award-winning outsourced bookkeeping and account solution ecosystem. We only use Xero and we specialise in that. We've been using it for 8 years now.
Excellent, thank you very much. And Paul?
Good morning, Paul Simpson, Taxist Accountants in Market Harbour, Lutterworth, Blaby, Lincoln and North Hykeham now, as from today. We specialise in small businesses, so we help people with their requirements, all their accounting requirements, again with the help of Xero. We also use QuickBooks and Dext, and really to try and get them to take the pain out of the bookkeeping. We only deal with small businesses, so we're not dealing with, we don't do audit or anything like that at all.
Okay, thank you very much. And Roger?
Yes, I'm Roger Meadows from Essendon Accounts and Tax, often referred to as the business godparents, not just the business godfather, just in case you're a bit worried. But yes, so we're there for our clients, getting our hands dirty with them, as well as doing all the compliance work, etc., like people's tax returns, VAT returns, etc. But yeah, very much there on the other end of the phone to support them and guide them in their business journey.
Excellent. Okay, so I don't know whether there's a collective noun for a group of accountants. So I'm going to call you a gaggle of accountants this morning. So the intention of the session today is really just to get your insights into the mistakes that small businesses might be making with tax, to make them aware of some allowances they might not be aware of, have a little delve into sort of VAT. Should people be on the flat rate? Should they be on the standard rate? What should they do there? And what's your insight into that? And also maybe have a little look at R&D tax credits, which people might not be aware of as well. So it's an open forum, so you're welcome to butt in as and when you like if you see a point to be made. But I think if we just sort of crack on with the general question, what would you say are areas that businesses should be looking at that they may be missing out in terms of tax purposes? So I'll come to you first, Wendy, as you're on my screen. What would you pick on, or what would you highlight thing that they could look, say, should be looking at?
I would definitely highlight VAT. I think there's a lot of issues around VAT that people miss. People go on to the flat rate thinking that they're going to get some money back. But if they're doing a lot of sales that aren't VATable, they still have to include those in their VAT sales. So they can end up actually losing money by being flat rate registered. And also if they have an awful lot of purchases, high value purchases against their sales, they can't claim, excuse me, the VAT back on any of those when they're flat rate. The other mistake people make on flat rate in particular is you get a 1% reduction on your flat rate percentage for the first 12 months. And that is from when you register for VAT, not when you go on flat rate. So some people get that wrong and don't put their percentage up, so they end up owing HMRC money. So there are a few things just around the flat rate scheme. It's not cost effective for everyone. It's there to simplify the VAT, but it doesn't always do that, even though it says it does on the tin. But we are talking HMRC here. And it isn't always the best solution for people.
Yeah. So sorry, Roger, go ahead.
I was just going to say I concur with that, and quite often what we do with our clients is sort of do the two methods. One, what I call traditional VAT accounting, and show them what result will be there, and then compare it to the flat rate. Because you could be amazed, you could have one plumber who could be on a flat rate and another who shouldn't be on a flat rate, just because they do different types of plumbing.
Mm-hmm.
But certainly, we've got to be careful with flat rate, because particularly if you're very much in sort of a service sector, a consultant or something, the flat rate percentage is quite high, at 16.5%. And what we've got to bear in mind is the flat rate percentage is applied to a VAT inclusive figure.
Mhm.
So if you've done a sales for £1,000, you add the VAT on it, 20% to 1,200. That's what you apply your flat rate percentage to.
Mhm.
And people don't often realise that. When you actually do the maths, the 16.5% actually works out, I think it's about 19.8% VAT, and you can't claim any of your purchase VAT. So it doesn't make
so
sense.
it's not cost effective if you're in a service industry at all, is it really?
No.
Yeah, I guess it's horses for courses at the end of the day, given the structure of your business. But essentially, what the standard, if you like, normal way of working out VAT is basically the VAT on your sales minus the VAT on your costs, and then you just sort of like pay a percentage on the difference. Whereas flat rate, am I right in thinking that flat rates vary by industry sector, and all you're doing is you're just paying okay.
Yeah, and you can't claim VAT back on your purchases unless you can on some large asset purchases, but on your normal day-to-day purchases, you can't claim any of your VAT back. So as Roger says, if you're a service industry and you're effectively paying 19.8% VAT and only getting that 0.2% back, your actual purchases could be a lot more than that. So it could actually be detrimental to your cash flow rather than helping you.
Yeah. Is there anything you want to add, Paul, on the VAT topic?
No.
Well, I have known businesses will sometimes there are restrictions, I think, on you changing from one process to the other, Paul. So have you had experience of when it's beneficial to be on a flat rate and then maybe change back to the other one?
We're not really. I would defer to Wendy and Roger's extra their knowledge on this. We don't have huge numbers of VAT registered clients because we're dealing with small businesses. Really.
Oh, okay.
We do come across it a little bit, but Wendy and Roger will come across it a lot more. So it's a hugely complex area and one that shouldn't be entered into lightly, really.
Yeah. So what do you know what the rules are, guys, in terms of changing between the two and what the limits are?
I'll let Wendy answer that, or Roger.
Yeah, sorry. Guys, sorry. Yeah, thanks, Paul.
I know that there are rules around changing. The main changes people make is between cash accounting and accrual accounting. Again, that it can be beneficial to be on cash accounting, but you can only do that up to a certain income level. Okay, all right. Well, thanks for that. If we move on now to Paul, then what would, looking at the overall arching question, then what would you say are areas that small businesses are probably not really paying enough attention to when it comes to tax?
Well, the first thing is, of course, they don't keep proper records. So the first thing we suggest to anybody that's going into business and working for themselves is they keep proper records. That doesn't have to be Xero software, QuickBooks software, anything like that. It can just be on a spreadsheet, it can be on a paper file. Obviously, by using bits of software such as Xero and QuickBooks, enables you to analyze information and keep it all in one place. But the big thing we always say to people when they're starting a business is, well, however you record your information, record it. Make sure you record all your sales. Just write them down in one piece of paper or on a tab on a Excel spreadsheet, and record all your expenses. If you're not sure whether to include an expense or not, include it, and then we will make the decision at the end of the year for you whether you can include it. The common mistake that a lot of people forget is a lot of people work from home, so they forget to claim an allowance for working from home. And HMRC are fairly generous with this; they'll let you claim £6 a week for that. A lot of trades don't claim what we call messy working allowance, which is for laundry and clothing, and that's £8 a week. A lot of people don't claim that. A lot of people seem to forget to claim mobile phones, because they've got a mobile phone. It probably goes through maybe their own personal bank account, so they forget to claim that, or a proportion of it for the business. Same goes with internet usage as well. And what we always say is apart from the requirement to keep records and keep records, very, very diligently, is always put your business through a separate bank account. We hate it when we get clients and they say, "Oh, I'm running this business and it's all going through my personal bank account." You've got thousands and thousands of transactions to pick out, 100 or so, a couple of hundred, which is actually related to the business. So always use a separate business bank account. There's lots of providers out there, lots of online providers now that will offer business bank accounts without any charges at all.
Yeah, I mean, certainly nowadays it's a lot easier, to use something like Tide or Starling or those others are available, I'm sure, to set up and have it be a separate and distinct thing. But yeah, I do come across small business owners where they're just the whole of one account, so it makes it quite complicated, doesn't it? Roger?
Yeah, I think it's quite important to have it in a separate account because at the end of the day, everything's self-assessment with revenue, and if the revenue raised an inquiry, they will ask for business records. Mm-hmm. What I don't really want my clients to do is to be able to then have to send over their personal bank statements because it's got all their business transactions recorded in it. I mean, I can remember I had an inquiry into a musician who provided private guitar lessons in the evenings, and they inquired they wanted to work out or justify what he was putting through his records in terms of sales, etc. Well, he had to hand over his personal bank statements, and in it was a lodgement for 100 quid on the 28th of December. So the revenue said, "Oh, well, that must be a guitar lesson then, in between Christmas and New Year." And he said, "Oh, no, it was a Christmas present from my sister." And they said, "Well, prove it." And he said, "Well, I can't." So he said, "Well, we're going to tax it then."
Right.
So, handing him over information that's not related to the business, they will start looking at it and then they'll see where it goes. And it just causes more work, stress and nothing like that. So why not just open a simple bank account and just keep it all there?
Absolutely. I mean, I had a client who came to me with 11 months worth of paperwork, literally in shoe boxes and carrier bags, literally. And he, I don't know if I've made any money or not this year, but I think I have. And when I went through everything and worked it out, because he was putting everything through his joint account, where his wife's wages were also going, it masked the fact that he'd actually lost money. So he'd worked all year, he'd worked really hard in his business, and then I had to break the news to him, "Well, actually, you haven't made anything, you've made a loss," because it was being masked by the other money that was going into the joint account. So that's another reason to keep your own bank account, because it gives you a clear idea of what's going on in your business, which you can't have if it's going into a personal or joint bank account.
Yeah, absolutely. So, Roger, are there any other areas in the tax domain that you think businesses are either missing out on or making mistakes?
Well, I quite often get new clients who come and see us and said, "Oh, we've done everything ourselves, but we have no idea whether we're claiming if and we should." So, I mean, Paul's given us a few examples, but most people, if they've never spoken to an accountant before, have no idea what, for example, tax capital allowances are.
Yeah.
And at the moment, the revenue have got quite generous capital allowance regime. In other words, if you claim, if you buy a piece of plant and equipment, which could include a laptop, the revenue will give you a tax allowance of 100% of that in year one.
Yes.
Whereas normally, what most people do is that you think, right, okay, the laptop will last 5 years and they'll depreciate it for over 5 years and they'll take a fifth of it in the year one. Well, actually, you can accelerate your tax relief by claiming these allowances to start with. Or people buy assets and never claim the allowances. I mean, we've got some clients who, for example, have got properties that they rent out as effectively serviced accommodation. Well, that's not classified as investment anymore, rental income. It's classified as a trade. Well, they can start claiming allowances on things like integral features like, electric light switches and light bulbs. It's like that. Whereas you need to have a specific tax advisor who specialises in tax allowances to be able to put that claim for you. Otherwise, people miss out on it because they're just oblivious to it.
Yeah.
And it's even better than that at the moment. You can claim 130% capital allowances on lots of things.
That's indeed, yes, it's the enhanced allowance, yes.
Enhanced allowances. So, it's essential. We tend to meet with our clients before their year end, if they're limited companies, 2 months before their year end, to just see if there's anything that they want to buy or they've already bought that can mop up the allowances and reduce their tax bill.
Yeah. So if someone has made a mistake historically with their tax and they haven't put these allowances in, are certain ones backfittable, or is that if you've not claimed it in 1 year, that's it, it's game over?
Well, you can go back and submit historic tax returns. There's various ways of doing it. Some can be done electronically, some by paper. We can only really go back 4 years and claim that. But what a lot of people do when they're starting up in business is that they probably spent a lot of money maybe on training or on laptops and printers and all those sort of things. And they said, oh, well, I've spent it before I set the business up. That doesn't matter. We can still bring those into account in the first year of trading.
Okay.
Another tax allowance which I helped somebody with recently is they were a 40% taxpayer, and they were there was only 20% reclaim going on their pension contributions, and we actually we did a tax return for them. We claimed the other 20%, and I got them a £4,000 rebate. So if you're a 40% taxpayer and you're paying into a private thing to look at, you should definitely be doing a tax return. Even if you're PAYE, if you're paying into a private pension and you're a 40% taxpayer, you need to do a tax return.
And you do need to check, even if your pension is being deducted from your salary and you're a higher rate taxpayer. Some companies only deduct the pension contributions with 20% tax, so you can
absolutely
still tax, even if it's going through the company. You think, oh well, the company's dealing with it, or still going through PAYE. It might not be if it's only a net pay scheme.
Yeah.
So, and thinking of the same lines of pensions, when you're high rate taxpayer, some people forget about their gift aid charity donations.
Yeah.
You're busy. You might have membership of a national trust, for example. You've ticked the box, I'm a taxpayer. Yes, the National Trust get tax back, but if you're a higher rate taxpayer, you effectively extend your basic rate tax bracket to be able to recoup some of your high rate tax back. So it may not just be putting a tenner into the, to Council UK donation somewhere. It might be some regular memberships to charities that get you gift aid.
Yeah.
And
that's what, it can be sizable.
Yeah.
For some people.
Where's the sort of debate at the moment on whether directors should be taking dividends or going through PAYE for their income?
Well, we have certain. It very much depends on whether directors have employees or not. Because if you have an employee, you can claim something called the employment allowance, which is in effect a reduction of up to £5,000 on your employer's national insurance bill. So if you've got employees and you can claim the employer's national insurance back, then we would pay them straight up to the basic rate threshold of 12,570. Although this year, because they changed national insurance rates in July, it's slightly less than that. But if it's just a one-man band limited company, then we would normally restrict them to 9,100. Which means they don't pay any employees' national insurance and they don't pay any employers' national insurance either.
I'd restrict them anyway, Paul, because if you restrict them down to that limit, they'll never pay employees' national insurance. There's a sweet spot, and I'm sure Roger will, agree with this. There's a sweet spot that if you pay, there's an optimum director's salary. If you pay them at a certain level, they're below the rate at which they're going to pay any employees' national insurance. They get to the 5,000 to pay, they won't pay employers because it's also below the level. But they are above the level where they will register another year of earnings towards their state pension. So there is a real sweet spot there where they will never pay national insurance. However, there's a caveat to that. In order to take the rest of the money that they want out of the business or need to live, their business has to be making a profit to be taking it in dividends.
Yeah.
So it depends on the profitability of their business. If they're profitable, I would always recommend they take the employers, the directors optimum salary and avoid paying any national insurance, any employer's national insurance, and then take the rest as dividends.
Yeah, that's what a lot of businesses forget. They just think, oh, I'm a limited company, I just take a mixture of salary and dividends. But Wendy's right. If you're not making any profits, you can't take any dividends. And if you do create an overdrawn director's loan account and you've not paid that back within nine months, you have to pay interest on it. And that's
quite a lot of money, isn't it?
It's Section 445 interest. It's quite penal. So we want all our clients to make money, but with a couple of years that we've been through, then clearly they're not doing so. So it's important to make sure that you're making profits. And again, it comes back to what we were talking about on bookkeeping before. You can only really know that if you're keeping accurate live records on something such as Xero or QuickBooks.
Yeah, or worst case, I guess a spreadsheet, as you mentioned earlier, Paul. At least it's tracking your incomes and outgoings. Anything else you want to add on that topic, Roger, on the dividends versus salary?
No, it's you've got to be careful though, because you might want to do it from tax purposes, but you might need to think of other factors as well. So people find it harder sometimes to get a mortgage if they've got dividends rather than pay. They shouldn't if they use a good mortgage broker. But if you just walked into a high street building society and the computer might say no, because they'll be basing on a P60 rather than dividends. So, but you're limiting yourself to a number of mortgage providers. On the pension front, you can only put into a pension 100% of your earnings. So if you're only paying yourself 12,000, in theory, you can only put 12,000 personal pension contribution into a plan. The way around that is to make the company pay the contribution and make it an employer contribution. So the other you've got to get all your eggs in the row, because you might not have actually got your pension organised in the specific way that you need to. So, yeah, there's a few knock-on effects and other benefits you might receive from the state, maybe.
And what you've got to remember is the first £2,000 of dividends is tax-free anyway. So it's quite often a good idea to include your spouse as a director and a shareholder in the company as well, rather than just having it as a one-man band, because that's £2,000 worth of income you can have tax-free as well.
Yeah,
if you're doing that, it's important to have different levels of shareholder, because if you only have an ordinary shareholder and you put your wife in there or spouse just so that you can give them that £2,000 a year, they're on the same level as you as for that shareholding. Every time you pay yourself, you have to pay them. So if you're going to do that just to give them the £2,000 allowance, create a B share that will only pay out that £2,000.
We call them in our profession, we call them alphabet shares. So yeah, you'll have different classes of shares paying different dividends, and that's essential if you're not going to be paying exactly the same dividends. And so that can be done quite simply.
Yeah, sorry, Roger, go ahead.
I was going to say, one common people forget is that it's a £2,000 allowance. It's not just a £2,000 allowance from your company. So if you've got shares in Tesco's that give you £20 dividends a year, you've got to take that's part of your £2,000 allowance. I've quite often seen new clients come to me say, I'm taking my £2,000 out of the company, then I find they've got £1,000 dividend elsewhere, and then they wonder why they're getting taxed. So it's simple things like that. And yes, alphabet shares is a way, but sometimes you have to be careful because there is settlement legislation out there, but that's too big to go into now.
That's another session on its own, is it? So yeah. I often come across small businesses that put their partners on the books to sort of make for sort of tax benefits. Is that a legitimate thing to do? Does the partner have to be seen to be contributing to the business, or is it just purely a bit of a, for want of a better expression, a tax dodge?
Well, it's you have got to be careful. Yeah, it's part of that settlement legislation as well. They do have to take an active role in the business, otherwise the revenue can't do challenge cases where they've got one spouse who's at home doing nothing, the other earning an awful lot, and then you're trying to shift it between the two. So they will want to see that that other person is doing something, even if you can demonstrate it as admin for the spouse and pushing paper around their desk or something like that. But yes, you do have to be careful. But
Yeah, everything's all right till you get a HMRC investigation.
Yeah, which is it is a bit of a dodge then, by the sounds of it. Okay, yes, okay.
It is.
Sorry, Wendy, go on.
If your wife is at home and she's answering the phone for you, she's taking messages, she's doing some stuff, then she is doing something. But if you're paying her the full 12,570 so that you can claim all of her tax allowance, is she doing £12,000 worth of work just by taking 2 phone calls in a day? She's on a hell of an hourly rate.
Yeah, it's not a bad rate.
Yes, you do need to be careful how you do that. I agree with Roger there. It is one area that HMRC love to look at.
Yeah, I bet they do.
But make sure you're paying them a minimum wage as well on the other side.
Exactly.
Yeah, otherwise you got that. Yeah,
if she's doing you 80 hours a week and you're only paying £100, you're below the minimum wage, aren't you?
Yeah.
You are.
So any other areas that we haven't covered yet that you think is worthwhile just sort of mentioning for small business to look at?
There's something that I think any sole traders are going to have to look at, and that is MTD ITSA. So it's Making Tax Digital for Income Tax and Self-Assessment, which will come in 2024, which will change the way that self-assessment is done from doing 1 return a year to 6. So by that time, anybody that is using spreadsheets will have to be using government HMRC approved software, because the returns will have to be filed quarterly and through that software. And then there's 2 additional returns to file. So if you're looking at starting a business now, I would suggest getting on to whatever software it is that you prefer, whether it's Xero, whether it's QuickBooks, or any of the other softwares that are going to be taxable in order to file those returns come 2024, because it's not that far away, really.
Yeah, it'll soon be on us. I mean, I guess you're moving all your clients towards that if they're not already on the right platform.
We would always recommend people at least consider some software, and it's people think, oh well, it's an extra expense. Well, yeah, but it will save you a lot of time in the future. And as Wendy says, when you've got to be submitting 6 tax returns a year, it's like anybody that's VAT registered at the moment has to submit a quarterly return. It's going to be exactly the same basis as that.
Yeah. Do you think this will help small businesses? I know the admin is going up in terms of the submitting tax returns, but do you think it's beneficial in as much as they'll be paying more regularly rather than waiting for a big bill to come in at the end of the year or whatever? What are your thoughts on that, Paul?
Well, I think it's beneficial if you've got a business owner that wants to actually grow their business and see how it's performing, because on a quarterly basis they can see whether they've made a profit. For a lot of smaller business, your painter and your decorator or your plumber or whatever, they know they're making money because they've got money in the bank account to pay their mortgage and their bills. And it's a bit like using a sledgehammer to crack a walnut, I think, in some respects. VAT is okay because it's only comes in at 85,000, so it's dealing with larger businesses. It will be helpful. It will be incredibly helpful to HMRC. Whether it will be as helpful to the clients that have got to submit for tax return, obviously it's going to be very helpful to the accounting profession because it could provide us with a lot more work. Whether it will actually provide any great benefits to the small trade, or whether it will just increase their administrative burden.
I suppose it gives it.
Sorry, you have to look at the businesses that are very seasonal. They might have a huge, fantastic summer because they're a seasonal business, and winter, barely any money coming in. So, that's why you have to do the extra ones at the end of the year to ratify those 4 quarterly returns.
Roger, you were going to say something?
Yeah, I was just going to say, particularly for some clients, they like to have the discipline of paying their tax. Let's go. They might have been unpaid jobs up to now, paid all their tax every month. Some come to me, like someone started their business in April this year. They're not going to pay their tax until January 24.
Mm-hmm.
And they're saying to me, well, okay, I'm not going to pay. I might have spent it all by then. So I have to encourage them either to pay the revenue up front or to put it into a savings account. But there's certainly a lot of members of society, if they've got cash in their pocket, they'll spend it.
Absolutely.
Yeah, worry about the bill later. Yeah.
Around personal tax as well, the other thing that people that really does catch people out when they start a business is if their tax bill is over £1,000 on their first tax bill, they then have to make payments on account, and their payment on account is 50% of this tax bill towards the following ones. So people look at their tax and they look at what they've earned and think, well, I'm going to pay 20% on that. Not if your tax bill is over £1,000. You're going to pay all of this year's tax and 50% of the following year's tax at the same time, and that can really screw people up because they have no idea that that's coming.
Yeah,
well, it's a real advantage to get your tax return in early. If you can get your tax return in early, work out your tax computation before the 31st of July, then potentially you could reduce that second payment on account if your profits have reduced. So we always encourage people to try and get the tax returns in as soon as possible.
But it's the people that are filing their first tax return, because those payments on account, I think once you get into that flow, you're just paying the balancing payment and then the next payment's on account, so it's not quite so bad. But the first year that you are self-employed and you're paying a full year's tax plus 50% towards your next year's tax all in one go, so you're paying 150% of your tax bill in one go, that's when it hits people hard.
Yeah, I often come across small businesses, or you see it in the public domain sometimes. I've just had this surprise tax bill, and that's quite an odd expression for me, because you know when these tax bills are due, and I guess it is what you guys touched on is people are spending the money in their business without worrying about the surprise tax bill coming through. So have you got any recommendations there about what businesses should be doing? As Roger touched on, should they be siphoning off an amount as the thing and put it in a savings account or whatever it might be? And if so, what sort of percentage would you recommend?
We would normally recommend 20% of your sales, because 20% is basic rate of tax. Now, clearly, you've got a basic rate band, and you can have expenses coming off that income. But like Wendy says, you're paying 150% tax in the first year. So 20% of all of your sales would go into a savings account. The beauty of that is if you have overcompensated, you've actually got money then to pay into a pension as well.
Yeah.
One thing we also need to remember, it's just not tax, it's national insurance.
Yeah.
So a self-employed person at the moment pays 9% national insurance. So effectively your tax is 29%. Now there's always this talk about it going up to be the same as employees' national insurance. So it will go up to 32% or 33%. So yes, I know we've got a personal allowance, but yeah, I think 20% is a good starting figure. But if someone's earning decent profits, they need to be saving a bit more, 25, 30%.
Yeah.
It really depends on what you're earning. But
absolutely.
Put it away.
Yeah, absolutely. So if people are getting into difficulty with paying their tax bill, what should they do? It's certainly, because I guess some businesses will just bury their head in the sand and hope it'll go away. What would your recommendations be if they do have this issue where they've got this bill, they can't pay it? What should they do to get through that?
They should speak to HMRC, because HMRC does have arrangements to pay. They appreciate that things have been tough the last few years or so. They are taking a fairly pragmatic approach to it at the moment. And they will allow you time to pay. So you'll be allowed to set up a structured. So rather than paying 6 monthly, you will be allowed to pay every month or so. They won't give you any discount. They won't reduce it. You've still got to pay the tax, but you will try and even it out over several months or so.
Yeah, and there's
that as well. If people have had as you say, a surprise VAT bill, which shouldn't ever be a surprise, you can also contact HMRC and have a time to pay arrangement or for corporation tax or for any of the taxes that you need to pay. Just don't bury your head in the sand and don't think that HMRC won't come after you, because they will.
Yeah, Roger.
The revenue will, once we get over the sort of pandemic residue, etc., they'll go back to assessing whether they will actually give the payment plan out. So they normally like to see household income and expenditure, and we'll probably like 5 years ago, they quite often turn people down with payment plans. So the next plan is actually you can finance your VAT or your tax bills. So most, a lot of solicitors and accountants now actually finance their tax bills to bring in working capital into their business. So it's a bit like an HP agreement. You go to the finance house, and there's several of them out there. They will effectively pay your tax bill for you on the 31st of January, but then you pay the finance company over the next 6 months.
Okay.
Or a year. So there is that sort of fallback option if the revenue won't play ball.
Yeah. I guess that's quite an expensive way of doing it, though, isn't it?
Yes, but it's often just as cheap as if you were going to borrow or get a loan to inject cash into your business to buy a bit of equipment or something like that, or expand.
Okay. And am I right in thinking, Paul, that once that payment plan is in place with HMRC, you absolutely shouldn't default on that?
Oh yeah. I mean, the default position, of course, is don't get into that position in the first place.
Yes.
In other words, save your tax up. Do what we've suggested, maybe 20, 25, 30, whatever you feel you should be saving. Save it up anyway, so you know what your tax bill is. And again, we keep banging on about it, but there's so many benefits of having a QuickBooks or Xero in it, showing what your profitability is going forward. It's showing it can calculate the tax as you go along as well. So you shouldn't ever get into that position. If you do get into that position, do not mess with HMRC, and particularly don't mess with VAT, because VAT actually have more authority. HM Customs and Excise have even greater powers than HMRC.
Right. Okay. You've been warned, guys. Anybody listening or watching?
One last thing on VAT, circling back to that's just come to my mind is I have a couple of clients who are in the construction industry, and there's a new, fairly new VAT, which is domestic reverse charge VAT on construction industry. Now, this does result in some of my clients always, until they come to sell their project at the end of it, always on a reclaim. So they're always getting that back until the point where they sell the product they've constructed, each VAT bill. But what I've suggested to these clients is change to monthly VAT accounting, and you get that money back quicker because you'll get it back every month instead of waiting to get it back quarterly. So there can be an advantage and it's easier to do. You go into your VAT account and just request to do monthly VAT accounting. Yes, you have to file 12 VAT returns a year, but if you're always getting a rebate, then why wouldn't you?
Yeah, it's worth the extra admin, I guess, isn't it? From that point. Yeah. So, Roger, you were going to give us a quick overview of R&D tax credits, which people might not be aware of. So, do you just want to tell us about that?
Right. So, R&D, research and development. So, basically, it's where you're working on a new or improved product or service. It doesn't always have to be a new one. You could be, etc. But it's got to be something that is technically innovative. And basically, it's available. What happens is that you assess all the costs in relating to doing a particular project. And Paul touched earlier on about an enhanced capital allowance of 130% on plant and machinery. Basically, what with R&D is that's increased to 230%. So if you spend £1,000, you're actually putting through an expense at a level of 2,300.
Mm-hmm.
And basically, it's available for small businesses. You've got to have less than 500 people. For example, you can still be loss-making business, because what it does is it's for limited companies, so not for sole traders, things like that. You limited company. The way you get your money back is either paying less corporation tax, because you've got this extra expense going through, or you can cash in your R&D tax credits and get cash back rather than paying less tax.
Yeah.
And obviously that sometimes people will, or some firms will go down the cashing in route, because actually it helps with them financing the next stage of the project and things like that. And you can do R&D on the same project for year to year. It's not just restrained to 1 year.
Mm-hmm.
So we've got someone in the space industry. He makes an R&D tax credit every year because he's always doing something to push his product further along the line. So, but the costs include staff costs as well. So if you've got someone who's working 50% on a R&D project, you can claim 50% of his salary and associated costs, as well as obviously the raw materials and products and services that you buy in for that project. So, but I always recommend, us as a firm of accountants, we wouldn't actually get involved in doing the R&D calculation. It needs to be done by specialist R&D consultants, because it's the book's that thick,
Yeah.
And and it goes to a special R&D department in the revenue, and they're now withholding a lot of the claims because they're now examining them, and it all gets technical and things like that. So basically, you need to employ a special R&D tax consultant, and they basically earn their money by taking a percentage of what they get for you.
Yeah, that's pretty much the drill. Yeah, so it is a specialist area for sure, but definitely worth looking at. If you're doing innovative stuff within your business, and like you say, there's certain allowances you can offset against that to get potentially cash back into your business, which is always, cash back is always good, I guess, guys, isn't it? Into any business.
Absolutely.
So before we'll just to wrap this up then, before we do wrap it up, is there anything else you want to add that we haven't touched on? Because I think we've covered quite a plethora of different areas to boggle the mind. So is there anything else that you think you need to mention before we shut this down?
Just don't ignore brown envelopes when they come in the post. That's another tip.
Yeah,
and ask advice. You may not need take on an accountant to do everything for you, but there are accountants out there that will give you some advice that will help you, and offer a free initial consultation or whatever. So don't be afraid to ask, because you could be missing out on so much.
Yeah,
I'd just say HMRC never ever contacts anybody by telephone or by text message. If you get contacted by a text message saying you've got a refund and please fill in your bank details here, it's a scam. HMRC are lovely antiquated, and in the majority of cases will only correspond with you by post.
Yeah, likewise, if you get an email purportedly from our HMRC as well, it's just a phishing email. Get your details, so be careful. Yeah, good advice, Paul. Okay, well, thanks for coming on today. We're here every Tuesday at 11 a.m. looking at different topics across different themes. Next time is going to have a slant towards sales and marketing, and we're actually going to look at sort of how you maintain your brand across the different marketing platforms that you may have. So please tune into that next week. And thanks again, guys, for joining me. I'll end the conversation there.
Thank you, Paul.